Hello dear students, we'll be beginning with ratio analysis, another chapter in your management accounting portion. Now the first formal question that arises is why ratio analysis. Ratio is a very simplified form of expressing complicated data, right? So like if I say that the last year sales was 5 lakhs and this year the sales is 3 lakhs, a lot of people may get confused, may not remember the data, things like that. But if I say last year and this year the sales ratio is 5:3, automatically you can conclude, okay, last time it was 5, this time it was 3, so basically the sales has come down. So that's the reason why ratio analysis has been importantly dealt with the management level people, definitely to understand the whereabouts of the business. Now as you can see on the very first explanation page, they've given with the meaning and other theory details that you will be taking up, and we will discuss definitely. But then classification of ratios, that is the first portion that I would like to highlight, that should be on page number 4.4 for you. And there are 4 categories like liquidity ratio, solvency ratio, activity ratio and profitability ratio. Sometimes they are expressed in the form of percentages, sometimes the denominator is changed into 1, sometimes it's the pure ratio form like A is to B, that format. So we'll be getting to know slowly and gradually as to which ratio is expressed in whichever way. The first category, that is liquidity ratio, so short-term solvency ratio also it is called, that has 2 subcomponents in it, and you can see the first one being current ratio. Now current ratio, if we express it formula wise, it is current assets by current liabilities. Now we all know what is meant by current assets and current liabilities, isn't it? So current assets like current investment, inventories, trade receivables, cash and bank balances, short-term loans and advances and other current assets. So that taken, and current liabilities will be trade payable, short-term borrowings, other current liabilities and provisions. Nothing to worry because you've got all that written in the book. Not only that, if the working capital of the concern is also given, we can back calculate and find out current assets and current liabilities. Now the first thing is that you might get theory questions in the compulsory section where you would be asked to identify the ratio or the component and justify or give the reasons. Now what is the tag question that you generally get? We will be discussing that in the class, but I would like to highlight now illustration number 3. If you can come to there, and you've got components like debtors, receivable, prepaid expenses, cash in hand, bank, current investments, inventory, all those are there. And there are current liabilities also like creditors, bills payable. So if you segregate under the categories of current assets and current liabilities, you'll get the total of 2 lakhs and 1 lakh respectively. So when you express that as current ratio, it will be 2 lakhs by 1 lakh, that is coming down to 2:1. Now that's already solved in your book, so nothing to worry. Thereafter, you've got a list of illustrations followed with the same ratio, and somewhere in some illustrations you found out the working capital approach also. We are finding out the missing figure of current assets or current liabilities, and then you have effect of a transaction on current ratio. We'll be taking up definitely details in class because that's a much more wider and detailed concept. The next category is quick ratio or liquid ratio. Now quick ratio is associated with current assets and liabilities only. Like you can see the formula, denominator is same, current liabilities, and I don't have to explain it further. But what are quick assets or liquid assets? It is also popularly called as asset test ratio. What are quick assets or liquid assets? If you see, the formula is all current assets minus inventory, that would exclude loose tools and spare parts, minus prepaid expenses, that will give you quick ratio, quick assets, right? So if you take up this particular illustration where should be 19, and this is illustration 19, current assets total coming to 1 lakh 8 and current liabilities 54,000, right? Now if you think that they've given us a list of current assets, so we know 1 lakh 8 minus certain things will give us the quick assets like they've calculated, or the liquid assets. So 1 lakh 8 minus inventory of 52,000 minus prepaid expenses of 2,000, and that's coming to 54,000. Whereas current liabilities, the total already has been given to us, and when you find out the ratio, it would be 1 lakh 8 by 54,000, so that's coming to 2:1, the current ratio, and the quick ratio is coming to 54,000 by 54,000, so it is coming to 1:1, right? Like when we include all the details of calculating quick assets. Now furthermore, you will be finding, in some places total current liabilities, assets, everything is given, and you are somehow getting all the data and information in your sums to find out quick assets and current liabilities wherever relevant. So that was the first portion. We dealt about the first category of the ratio. Second category, solvency ratio. This should be around page number 4.22, of which the first one is debt to equity ratio. Now the name itself is quite easier to give you a hint. Debt to equity means what? Obviously debt will form the numerator and equity will form the denominator. Now what is that? Of course it's a summation of long-term borrowings and long-term provisions. Everything is written in the book and we'll be taking up in the class, so nothing to worry. Don't get confused. Go gradually, slowly. Equity shareholders fund, that is share capital plus reserves, that's one approach. And the other one is, if you don't have capital reserves, then you take the liabilities approach, which will mean non-current assets, then plus non-current investments, working capital minus non-current liabilities, and so on. Now if you take up that particular illustration which is there in your book, should be illustration 40, where you've got fixed assets 6 lakhs, gross value, accumulated depreciation 1 lakh, non-current investment 30,000, current assets 2 lakh 50, and so on. There if you find, see, they've calculated equity like 5 lakh 50 plus 2 lakh 50 for current assets minus current liabilities minus non-current liabilities. So they've applied the same formula and they've got hold of equity to be 2 lakhs, right? How will you calculate non-current assets and non-current liabilities? They've shown that also. And debt is long-term borrowings plus long-term provisions, so that is coming to 4 lakhs. Eventually your ratio would be 4 lakhs is to 2 lakhs. Then you've got proprietary ratio. This is almost similar to the previous one, debt to equity only, because if you see the numerator and the denominator, proprietary ratio also has shareholders fund and total assets. Now you already know what are total assets. I've already explained what are shareholders fund. So when you find out component wise, they will be giving you the answer for that. I'll take an important illustration. This is IAC specimen paper 2018. Should be illustration 46 in your book. So equity share capital 2 lakhs, 10% preference share capital 4 lakhs 75, and so on. If you see general reserves and surplus, creditor, bank loan, fixed asset, non-trade investments, and current assets. Now when we are trying to find out proprietary ratio, we need shareholders fund. So shareholders fund would be a summation of capital plus preference capital plus reserves. That's coming to 725. And total assets will be net fixed assets plus 2 non-trade investments plus current asset. That is coming to 10 lakh 35. As simple as that. So proprietary ratio would be shareholders fund by total assets, which is coming to 725 by 10 lakh 35, which is 0.70 is to 1 or 70.04%, right? And then you have debt to assets ratio and so on. We will be taking up furthermore the chapter in the next class from here. Thank you everyone.